Hello everybody, I'm Terry Ryder, founder of Hotspotting, and welcome to today's special webinar event in which we're discussing a form of property we don't often talk about at Hotspotting, but one that presents a host of attractive possibilities for investors, both large and small, and that is service station real estate. The thought I've often had when using a service station is what great real estate it is. Always a large site on a busy thoroughfare or highway, always prominent, visible, and highly accessible. But there's a lot more to know about this compelling form of real estate investment. And to help us understand more, today I'm joined by two experts, Peter Rossi from Amplify Funds Management and Steve Polizzi from Polizzi Property. Firstly, Peter Rossi, welcome. Tell us a little bit about your business and how service stations are part of what you do.
Yeah, thanks, Terry. We've known each other for a long time through sort of the property industry, over sort of 30 odd years. Amplify Funds Management is a small sort of almost a more co-investment type business where myself, Andrew Dowling, and Peter Honeycomb have come together. We've all worked together for about 20 or 30 years. We've come together and we decided that we'd like to do some investing of our own and co-investing. So what we're doing is we're selecting assets that we would buy ourselves, maybe outside our financial reach. So we're acquiring these properties and looking for like-minded investors to invest alongside us. With some of the funds that we've done, we've invested sort of up to 25% of our own cash. So we sit in there, cheek to jowl with the other investors, and then we're joined by other sort of private individuals, mostly self-managed super funds and private investors themselves.
Okay. We'll come back to how service stations fits in amidst all of that in a moment, but welcome also to Steve Polizzi from Polizzi Property. Steve, you look like you've just woken up early in the morning somewhere in the world. What's happening?
It was touch ago when I made this meeting. It's 4 a.m. I'm in the UK at the moment, so yeah, made it just in time.
Okay, so just tell us for the benefit of our viewers and listeners, Steve, a little bit about your business as a buyer's agency that helps investors who are interested in commercial forms of real estate.
Yeah, so we basically just run the whole process for an investor. So we do buy like owner-occupied premises, but 90% of our work is investment. So anything typically with good tenant, good location, good yield, long leases, versatile premises. But yeah, we buy around 20 a month. I've got now close to 2,000 properties under my belt, so quite a few. And we've bought in every capital city, every major regional town, lots of petrol stations, warehouses, retail, shopping centres, even offices. Even I'm not a huge fan of office space, but we still buy some of those. So good kind of spectrum of properties. But anything that I think is going to make financial sense long term, not short term. Commercial is always a long term game, is what we go after.
So all those qualities that you just mentioned, the sort of things that you look for your customers, well located property, strong tenants, long leases, good yields, sounds very much like our topic today, doesn't it? Service station property.
Yeah, and location-wise for petrol stations as well and service stations is they're typically corner blocks as well with really good exposure, and that's another huge plus.
Yeah. Okay, so Peter, let's just talk about the nature of this form of real estate. What's good about owning a service station property?
Oh, look, I think it's really great to hear Steve talk about those attributes because they're the attributes that, as I said, we want to invest in these things ourselves, and we do and are investing in these things ourselves. But generally what we're looking for is a piece of property that's a fundamentally good property. So it's in a great location, high exposure, etc. We take that property and then we overlay a very strong tenant over the top. So, generally these things are leased to either your Caltex, your Shell, or Viva Energy, Chevron, BP Australia. They've got very good, very strong tenants who tend to take long leases because they've got a lot of infrastructure that they put into the assets. So we're sort of looking for good locations, strong tenants, long leases. Generally, they take net leases, so there's no erosion of the income that comes from the site. And they make a good long-term proposition. And that's really that's really what we're in it for. We want to generate for ourselves a good cash flow over a great many years. And they're the sort of assets that do that, albeit that they're specialized. I think there's been a real change in the composition of the business within the service stations. And that's another important aspect, that people are actually running a viable business from the sites. And if you've got a high volume service station, then there's a good reason for it being in that location, and the business, albeit the on-site actual local business, supports the continuity of trade there.
Yeah, I was interested to read the report you sent me, done by a firm called Cushman and Wakefield, about the nature of service station properties. And part of that report, they had a series of pie charts depicting the service station properties of the past, the ones of the present, and what's imagined that they will evolve into in the future. It was quite interesting to see just how much has changed and more that is expected to change as we go forward.
Yeah, it's exactly right. I mean, it really is a change. It's a dynamic. I mean, I've spent most of my career in the retail field, and sort of retail is detail. But it's one of the things that it's a dynamic industry. It's always changing. And I think for with a bit of grey hair and a bit of no hair, sort of in this seminar, that they have changed from the survey that was just a really where you got the pump jockeys that are out there pumping fuel and cleaning your windscreen. Now it's evolving into a convenience retail offering. So in many regards, in a lot of the communities and a lot of the suburban areas, what you're seeing is the service station is replacing the corner store. So if you want a carton of milk, or you want a loaf of bread or a packet of chips or something like that, you're not going down to the local store anymore. That retail is now happening in the service stations. So I think historically there's been about a 70-30 mix of fuel products through to retail products, those non-discretionary convenience products. And we're seeing that a number of the fuel operators now, it's sort of changing their business mix, and they're seeing it actually flip on its head, and they're forecasting that some stage in the future it'll be about 30-70, with 30% in fuel, 70% in retail. Viva Energy, a big crowd, have just bought a business in South Australia called OTR, so which is On the Run, and they're really driving the food element of that, both packaged food and also fast food, what they're calling quick service restaurants.
Okay, so Steve Polisi, in your work as a buyer's agent, what is it about service station property you find that does attract investors to this form of real estate?
Yeah, so the two things for me and my clients, first one is it's very hard to get an oversupply of petrol stations. So councils are very strict on where they put them and where they allow them. So assuming you check council plans, you're never going to have to worry about, if you've got a successful service station now, that in the next 10 years, it's going to become an unsuccessful service station, because if they're not making any more, population's growing in that area. As same with residential, Terry, it's like supply and demand. You can never have too much supply, whereas office space and retail, very easy to oversupply the area with shopping strips. So that's the first one. The second one is typically the yield. In this market, an electric car discussion, which we're probably going to have later, there is a massive fear around them. And most of it's actually irrational fear. The yields are really strong. Like, you can typically buy a service station 6 to 9% net yields, depending where you buy now. And then, as Peter mentioned, you get really long leases. You can very easily find 5, 10, 15-year leases on petrol stations, which is very difficult in this market for any other asset class. Yeah,
and I imagine the strength of the covenant is also an attraction to investors.
Yeah, exactly right. So, but it's just, it ticks the boxes of low supply, high yield, very long leases, stable tenants, successful businesses. Like, on paper, there's not much to worry about long term, but we're going to discuss some nuances as well.
Okay. Yeah, I think one of the things that we also looked at when we were sort of investigating this, this sector, is that you're dead right about the council and the town planning legislation that's around these things. And if there is to be a competitor that comes in the market, they're very visible, because they'll have to go through a planning process where they have to advertise, and the incumbent people can lodge their thoughts, and because they're generally out of town. So, and I think with what's happening, there's more likely to be sort of fewer than more service stations. You're probably more likely to encounter less competition than more competition.
Yeah, spot on.
Another factor there, I imagine, is it's not necessarily that easy to get hold of the sort of site that you need for the ideal service station location. It needs to be a large chunk of land, ideally on a major arterial road or highway, and on a corner, so much the better. So hard to get that kind of real estate.
It's also expensive to set up. Oh, sorry, Peter. But yeah, petrol stations and service stations, you don't just throw 200 grand and you can knock up 3 concrete tilt-up panels on a roller door like you can in an industrial shed. Like, there is a lot of cost. So once it's actually there, someone's put quite a lot of money into that investment.
Yeah, it's exactly right. We're seeing that the sort of, and especially going forward, which goes back to your scarcity argument, Steve, is that with the service stations that are pre-existing, that are city and already established, if you've got to build a new one, the cost of doing that now is so far beyond the replacement cost of the asset that's sitting there. I mean, we've got one of the assets that we're looking at buying. We're paying roughly $2 million for it, and the tenant themselves are doing a refurb of the premises because they take care of all the capital expenditure. They're spending $2.5 million refurbishing it, and we're buying it for $2 million. So we see that as extraordinary value.
Yeah. Just speaking to the point you made, Steve, about the scarcity of this type of product. So I was interested to look at some of the numbers in the report, Peter. There are about 7,000 service station properties in Australia. It's not a lot, is it, for a country the size of Australia? But the other impressive number was the annual revenue that they generate, something close to $50 billion a year in a typical year.
Mm. Well, they are high, they're, as I think we were talking about earlier in the week, it's petrol's a very interesting commodity, and sort of the economists will tell us that it's an inelastic commodity. It's no one goes and fills up their car because they want to. People are filling up their car because they have to. And there's some, so you're doing that as a chore, if you like. So the revenue that keeps coming, it's been, albeit the fuel prices oscillate, I think they generally trend upwards, and it makes those, those service stations very viable businesses.
Okay.
It gives them some flexibility as well, because like you said, Peter, it's a chore to go there. So this is where the opportunity lies for service stations, because you have to go there. They've got value add for whatever they're going to do with the premise, like you said, and change the shift to shopping. They can change the type of asset for why we're going there. So it's got opportunities as well.
Yeah. And interesting, again, referring to the report by Cushman and Wakefield, Peter, where I referred to the pie chart showing the typical service station property of the past, the present, where it's involved with a much larger retail offering and services, but what they envisage for the future, and introducing this this other component called mobility. And I had to ask the question, what does that actually mean? And some interesting and pretty cool things that they envisage that service station property will consist of in the future.
Yeah, so Cushman and Wakefield have done a really good body of research in there, and in that mobility piece, what they're talking about, that includes electric vehicle charging points, but it also includes hubs for autonomous vehicles and delivery. So by autonomous vehicles, they're saying a driverless car that might be a taxi, it might be a delivery van, those sort of things. And this is sort of casting a little over the horizon. But also in that mobility, they're including car shares, so the Go-Gets and the Uber shares or Flexi Share, those sort of vehicles where you may or may not have a car of your own. You might go down to your service station, pick up a car, drive to the coast for the weekend, come back, drop it back off at the service station, and keep on going home. So that whole mobility piece is a real thing, and certainly I think the Go-Get and Uber car share or car next door are a real thing. I had the benefit of using one of those. I was in Sydney for 2 or 3 years, and I didn't have a car in Sydney. I would literally just go down the road, pick up a car, go off to wherever you went, off to the beach or off to the Hunter Valley, and then drop the car back in the morning. And it was a really affordable way of actually operating, because they pay the fuel, they pay the insurance, they pay the registration, and they pay the maintenance. So I think that might see a swing. but yeah, it's certainly a sector of the market that that's emerging. I don't think it's fully mature as yet. The retail element is certainly far more mature when you see some of the offerings where you've got a couple of fast food outlets and basically a mini supermarket on the service station sites. So people are using them as the corner store.
I think the location, Peter, is the critical part of where the flexibility lies as well. Obviously, like when you're driving up the coast on a big long road trip, those petrol stations and service stations have completely different kind of needs and what we can do with it. Like they're not going to be the Uber car shares. They're going to be the lifestyle, the big cafes, the gyms and things like that. Whereas the suburban ones, like you said, they're going to be the shift to more supermarket and servicing that local area, the residential. So the types and locations of them is going to change their flexibility as well.
Yeah, they're very diverse in terms of what market they service, and we've with this portfolio of assets that we've put together, and we spent a long time qualifying them. We've decided to go for the large service stations, so probably more so than the roadhouse. We're probably going the truck stops. Because we see the logistic traffic and the high volume of fuel that they need being very important. We've also sort of seeing that industrial refueling stations. So in an industrial area where the trucks may sort of take on their belly full of fuel before they head off, are also very important. The smaller service stations in metropolitan areas, we think will probably have the greatest impact from electric vehicles, because I think the EVs really suit somebody who's driving from home to work back to home. They may charge at home or they may charge down the road. But I think for anybody that's going, over 100 kilometres or over 150 kilometres, they're probably going to take their ICE, their internal combustion engine vehicle, as opposed to an EV.
Yeah. I assume as well, trucks are going to be take longer to pivot as well, because trucks are generally have a way longer shelf life than a typical car, because people rotate their car every 5-10 years now. Trucks, due to their cost, they're not getting rotated. You see 30-40-year-old trucks still on the road. So I imagine the shift to EV and the kind of more truck stop ones, that's going to be a long spread as well.
Yeah, it's an interesting point you make, and something that we looked at when we were assessing this portfolio and doing our due diligence, is that the batteries in a car. I think Volvo did a trial run, and they took a vehicle from Brisbane to Canberra, and it took them, I think, 3 days to do that in an EV, because they had to charge a number of times. The similar vehicle, the diesel truck, does that in 13 hours. So I think we're a long way off seeing battery-driven trucks. A fellow that we know that in logistics was sort of saying it'll go from being diesel into being biodiesel, and it'll hold at biodiesel for a very long time. And then the next shift after that is the hydrogen vehicles, but that's still a very long way off because of the infrastructure needed. I think the batteries that they're saying in a truck weigh roughly the same weight as 2 passenger vehicles, and for a truck to be carrying that load, it shortens their capacity to take freight, which is what's paying the bills, and also the weight of the trucks.
So, Peter, that kind of touches on an important element, particularly with reference to your portfolio, and that is the difference between the metro situation and the regional situation, and really with this type of properties, perhaps the importance of being regional.
Yeah, look, we love the regions. Amplify and Honeycombs are a business that are based in sort of Queensland, central Queensland, northern Queensland. We like the regions. It's slightly less picked over and better yields than you'll see in the metropolitan areas. I think people like to they will pay up for the benefit of being able to drive past their asset. We like the regionality. We're picking service stations and convenience outlets that are in very popular and diverse economies. And part of the reason for the 7 assets that we've bought that are up and down the Queensland coast is that they have that diversity of geography. So you're not in a situation where your petrol station, your one asset, may get hit by a cyclone or something like that. If that was the case, then we've got 6 other assets we can rely on to deliver the income to our investors. We like the diversity of the economy. So if somebody's got a drought or a flood, or that you've got a real spread. So we see that regional location diversification as being a real positive for the portfolio that we've put together.
Okay. I just want to remind everybody watching and listening that we welcome your questions. If you do have questions, please type them into the Q&A box that you should see in front of you, or the chat box, and we'll allow plenty of time during the broadcast today to get to those. So we're just starting to talk more about the components of the portfolio that you'll put together, Peter. Now might be an opportune time to share your screen. Just take us through your brief slide deck talking about that specifically.
Okay, I'll do my best here. So hopefully everybody can see that. So this is, we're sort of calling this the Amplified Fuel and Convenience Trust, and it really is, and we think that covers both sectors of the market in terms of the 2 cornerstones of the businesses that are occupying these sites. So we're putting together, we've got 7 fuel stations that we're putting together. They are across Queensland. I've got a little map. The portfolio for the investors will deliver an 8.5% on average distribution. That distribution will be paid quarterly, and by distribution, that's a cash on cash distribution. So if you put a dollar in, you're getting 8 cents a year back, and that's how that's structured. Over time, and over the term of the lease, it's a 12%, 12 or 12.25% total return, which is the income return of 8.5 plus the capital gain that'll sit on top of that. All of the petrol stations that we're buying are tenanted by Chevron, and Chevron use the Caltex brand. They're transitioning from Puma to Caltex. Caltex, obviously a very well-known and a very strong brand in Australia after 70-odd years of operation. All have very long leases, and in fact, out of the 7, only one of them has a lease under 10 years, and that brings our average weighted average yield, lease expiry, the WALE, to 9.77 years, so well beyond the term of the trust. In terms of an equity multiple, if you put $1 in over the term of the trust, you'll get more than $2 back, which is the combination of the 8.5 and the 12.25. And as I said, the diversification for us we see as a real risk mitigant in this. There are on 4 of the 7 properties, there are value add where we may be able to put in a quick service restaurant or a car wash or a coffee shop or something in that. So we think we can enhance the income throughout time. And we've got the development team that can deliver that. One of the important things, and Steve touched on it earlier, is all the leases are net leases, so there's no income erosion. The tenant is entirely responsible for all of the contamination on the site, if there is any. So the remediation of the sites sits fairly and squarely with Chevron and Caltex. So there's no risk of the owner there. And equally, because they're leasing the whole of the land, including the improvements, they take care of all the repairs and maintenance. And as I said, they're going through and spending quite considerable sums of money on their assets to make sure that that they're the best in class. And there's a couple of images that we've got throughout here that sort of show that they are, especially with this rebranding, the petrol stations are all looking pretty good. I don't know whether you had any questions on that.
Just keep moving through, Peter.
Yeah, right. Yeah. Well, they're the locations. So the gold tabs where we are the locations. So Portsmouth is in Cairns, and that's one of the industrial fueling stations that we're talking about. That's located in the centre of the industrial area and the marine precinct, obviously a high volume site. Atherton is the capital, if you like, of a very strong and diverse agricultural area up on the Atherton tablelands. A very strong town with with good numbers of sort of agricultural users, high fuel consumers. Bowley is the one that's in Townsville, similarly in an industrial area. So it was formerly known as the Bowley Little Acre. It's now a full Tectron Caltex outlet. High volume, it's a massive site in that industrial area. Lots of manoeuvring and parking rooms for probably 3 or 4 articulated vehicles or semi-trailers at any one time. So a really popular site. They've got a big restaurant in that facility and a big shop, which is obviously where the truckies are supplying themselves for the journey ahead. Charters Towers, west of Townsville, a big beef and mining area, very strong economy, and that sits on the Kennedy Highway. Again, a very high volume. It's a big truck stop. Probably, I think it's about 3.5 hectares. Chevron have got that earmarked for a full redevelopment of the site, including a fast food that they'll be funding. Next down, Gin is the Pacific Highway, Bruce Highway site, a massive site. It's got a very large heavy vehicle layoff area in front of it and across the road. In fact, very difficult for us to photograph because there was always trucks at the site. It's got a big shop and great facilities there for the truckies to have showers and resting facilities in there. So that's a really popular one. We really like that asset. Banana is in central Western Queensland. Again, a very strong mining area, a lot of heavy vehicle access through there, but also quite a rich beef cattle growing and small crops area in there. So again, we really have targeted these areas that have got diverse economies. Nambour, again, a great town, the administrative, health and education centre for the Sunshine Coast. That service station is located on an intersection that forms the gateway out to the Bruce Highway, out to the Pacific Highway. So a very convenient asset in that. But Nambour itself, obviously, with that education, with the health aspect, and it's well located in a strong agricultural area with a lot of the cane that's grown there. So as I said, those 7 sites, all tenanted by Chevron, and the branding is Caltex, so, which we're really happy about. Who is Chevron? Chevron is a massive US business. On the Forbes ranking, they're second in the energy sector, the second largest company that are in there. They're 22nd in Forbes global largest companies, so sitting in there. So you're dealing with a company that's got sort of $290 to $300 billion worth of market capitalization. They're a very wealthy and a very high principled company. They, in terms of what they're doing for the environment, having spent a fair bit of time on their website and doing investigations, reading their annual reports, etc. They're very high conviction in terms of their commitment to the economy, which is really good to know when you consider that back down at the local level, they have responsibility for remediating those sites if there is any sort of spillage, and they've got a very high conviction and enormously deep pockets. Caltex, as we said, I think every Australian that's probably over the age of 15 knows the Caltex brand. It's been part of the Australian idiom for a very long time, and that's the brand that Chevron have chose to roll their fuel offering, their downstream fuel offering out through. So very simply, the returns 8.5% per annum, cash on cash, a 12.5% internal rate of return or total investment. We're taking investments from $100,000. So Steve, I'd be interested in some of your thoughts on this. $100,000. I think if people are at the smaller end of commercial property, it's sometimes hard to get in, and you compromise the quality of your tenant. So we're happy to be offering, mum and dad that have got $100,000 to invest, happy to offer them the Chevron lease, the 10 years. I'd fail to add that those Chevron leases all have 4 times 10-year options. So it's not that they're there, they've got long-term commitments often beyond 50 years on those sites. Our investment term is 4 years, 4+4, available to wholesale and sophisticated areas. And as I said, we're picking those highway sites, industrial locations, and very strong regional towns.
Okay.
So going to who can invest, if you want me to sort of keep on going. So, you know, what do the investors want? They want secure and reliable returns, paid quarterly. The way that I sort of talk to people is you get 4 checks a year, no headaches. So that's it. All of the management happens to us. If you own a petrol station or shop, Steve, you'd be able to comment on this. Quite often you've got to be there doing work. We take all of that responsibility. So it's 4 checks a year, no headaches. The capital growth comes, pardon me, comes through the assets. Each of the leases have a certain increase of 3% per annum. So there is capital growth that comes through the increased income. Really good there. And at market review, which is at the end of the 10 or 15-year lease, that has a ratchet clause in us where, you know, the rent can't drop down to half. You've got continuity of those rents. Long leases, I spoke about the high renewal probability through the options, very, very low risk profile, no management for the unit holders. All of the debt is non-recourse debt, so there's no debt exposure. And we really like, it's a part of the story is that diverse locations across Queensland, across economies. So who does it suit? High net wealth people. You know, we're coming in at $100,000, so you don't need massive wealth. You don't need millions of dollars to invest with us. Self-managed super funds is perfect for that. Self-funded retirees, and we've got a number of those in our book already, and they're people that will live off the returns that they take from this. They get a check every 3 months, so 4 checks a year, and they can live off that. We're also seeing that a massive level of interest from the agribusiness sector, as some of these people that are very asset rich are taking these as off-farm investments. Family offices, trusts, those sort of investors, they're the people that we're seeing come into the investment fold.
Peter, if I'm allowed to ask, how much are you leveraging these assets?
Yeah, so the leverage is about 50. Well, it's not about, it is 55%. So we're not highly gearing these. So that gives us a little bit of headroom in terms of a debt profile. I think if a private investor went off and they were seeking to buy these assets, they'd be getting a loan to valuation ratio in the sort of 75 to 80% range. We're only funding it to 55%, so we're limiting the exposure. It's another risk mitigation factor for our investors to be able to make these returns. We want to be able to make sure it's a low risk return for their income.
Okay.
Okay, might be an opportune time to look at some of the questions. There are already quite a few that are pouring into the Q&A panel. And one of the first at the top of the list, and I know you touched on this to a certain degree, Peter, is how did Amplify determine which ones to acquire? Being regional was important, I think, in the first instance. Yeah, no, we
buying these from a single owner. And we went through, they had a far greater portfolio. We immediately sort of said we need to stick to our knitting. Where, you know, as property experts, you know, we know the areas, we knew the Queensland landscape very well, and we went through, we picked those that are away from the metropolitan areas, so away from the impact of electric vehicles. Not that I'm convinced, and I'm certainly not convinced that that's going to be a big impact going forward, but we thought that those sites that are away from that influence, and we didn't want investors asking us the question saying, "Oh, aren't you know, the big bad wolf here is electric vehicles," and we're just saying, well, we're 300 or 400 kilometers away from any of those. We liked the strong economies. We looked at those. We looked at each economy before we looked at the assets. So we started at 10,000 feet and saying, is this a good town? Do I want to own some property in this town? Is it a good location? Is it a strong building? So a strong business? Does it have a long lease? Are there certain increases? So there was a certain characteristic that we wanted each asset to have. We originally contracted 10 properties. We're going through our due diligence sort of phase that we went through. We did extensive legal due diligence. We did environmental due diligence, technical due diligence, and we've had them all valued. Pleasingly, the valuations that we had done came in above what we were paying for them, so we're pretty happy about that. So that's our process that we went through. We dropped 3 assets purely and simply because with Andrew Dowling and Peter Honeycomb and I, we looked at them and said, would I buy this asset for myself? And the answer was no. We said, right, drop it. If it's not good enough for us, it's not good enough for our investors.
Yeah, I'd be interested to see the stats, Peter, of like, I imagine, and I'm pretty sure I'm going to be right on this, the percentage of electric vehicles to petrol and combustion engines in these areas is way less than the metro areas. And like Terry knows my thoughts. I'm very weary about the metro petrol stations because I think they're just a small parcel land. But the regional ones, yeah, you're actually spot on. Like the uptake of that, until we've got spare batteries that a 4-wheel drive can put in the car, they're not changing to electric.
No, it's interesting. I've done a lot of research and I was in contact with the Australian Automobile Association, and I've looked through the registrations of electric or registrations of all vehicles across Australia and where they are, and which once you're down to disseminate to what we're calling the rest of Queensland. In that rest of Queensland, how many electric vehicles are in there? And the outcome of all the research, and I've got all the data to support it if anybody's interested, is there is less than half one car per 1,000 outside Southeast Queensland that is an electric vehicle. So the market share is very, very low. It's less than one in 1,000. What you'll see coming from the electric vehicle exponents is they'll talk about 20%, 30% of the growth. That's growth over a very, very low base. So if you got 1 and then you have another one, which is 2, that's a 50% increase. They talk about the growth rate. What we're talking about is the volume of electric vehicles as opposed to total registrations. And it's less than outside Southeast Queensland, it's less than half a car. In Southeast Queensland, Greater Sydney, which is from Wollongong to Newcastle, and in Greater Melbourne, which is Melbourne and Geelong, it's 3 cars per or 3.8 cars per 1,000. So there are not a lot of electric vehicles there. Is the number increasing? Yes, it is.
I'm just looking, Steve, at an article I've got here in front of me. It's from the Australian Financial Review last month, and the headline is the reason Australians aren't buying electric cars. And the key term that pervades this article is what they call range anxiety. The concern that people have is in the vast country that Australia is, and the distances that people need to travel on occasion, the problem of recharging and the availability, not only right now, but in the foreseeable future.
It's the whole reason I've got a diesel car for that exact reason. Like me and my partner travel quite a lot, and she's an ultra runner, and we go like bush quite a lot. We're not really, and she's actually got a master's in environmental sustainability, and we're still driving diesel for exactly that, the range. Like we don't want to get stuck somewhere where we're going to have to get someone to come out and tow us and that. Whereas it's very easy for someone to bring a jerry tank of diesel petrol.
Mm-hmm. I had a good mate of mine who went down to Phillip Island to see the racing down there, and they flew from Brisbane down to Phillip Island, and they got a cab down to the races. And when they left the races, the car that came to pick them up to take them back to the airport was a Tesla. And because of the stop start, the guy who was driving the Tesla said, "Listen, I've got to stop and put some electricity into my car." Pulled up, there were 3 cars in front of him, so it took them over an hour, and they only missed their flight home by an hour and a half. I think that range anxiety is a real thing. People, if they're going to take for a long haul, they're going to take the Land Cruiser or the Range Rover rather than the Tesla.
It's just
so that's probably a stat as well, Peter, as well. I imagine percentage of larger vehicles in these areas is way higher as well.
Yeah, the people in the bush are high consumers of fuel. We keep on. any way we flip this over, we keep on reaffirming our commitment to the bush for these bush service stations.
Yeah. It's in a country the size of Australia and the distances, it's hard to imagine a time when there can be enough charging stations to overcome what they're calling range anxiety.
Yeah, it's really hard. I think what we're seeing, and there's a couple of reports that are in the review over the last little while. I think we're seeing is that the appetite for battery electric vehicles, BEVs in the automotive lingo, that is decreasing quite markedly. There is what's the point of inflection is that hybrid vehicles are coming up a little bit. So people are saying, I'd rather a hybrid than an electric vehicle because it makes more sense that I can get a little bit more range. Ironically, we took a hybrid vehicle when we went to inspect all of these sites. We spent 4 or 5 days on the road having a look at each of them and driving around the towns and getting to know the real estate that we were buying. We took a hybrid vehicle. They perform well on the road, but a battery vehicle would simply not have got us to the destinations we wanted to go to.
Okay, we've got a lot of questions already in the Q&A panel, so let's turn our attention to a few more of those. David's asking, what role do the leases play in the value of the properties?
Oh, they're the cornerstones where all the money comes from. So, the money comes from Chevron. Why are they there and how long are they going to be there? That all forms part of the leases. They're 10 to 15 year net leases. So there's no income erosion and great certainty. Also, as I said earlier, they've got 4 times 10-year options. So, they've got a long-term commitment to these sites. And we spoke about the replacement cost. If one of these things, if there's one of these things burned to the ground, it's going to cost more than double what we're paying for the assets to reestablish those facilities. The leases are paramount. They're very, very, very good leases, which is why we've picked these assets and why we've gone exclusively with Chevron Caltex. Is their leases are superior to a lot of the other ones that are in the market. Our discussion with Chevron has been such that the leases that they're signing now, the new leases, aren't as good for the landlord as the ones that we're buying.
Right.
It's the inflexibility as well, Peter. That even if they didn't have a lease or had a shorter lease, they actually can't move anywhere. Like it's not like a warehouse tenant or retail, whereas if they don't like the owner or the location, they just cut the lease and move on. Because of the fit out costs of that, they're actually not you've got the business for the life of the business, not the actual location.
It's actually a really interesting point, Steve, and I know you're not a big fan of office, but they've also got massive amounts of goodwill embedded in the site. So if you own an office building and you've got an accountant in your building and they decide to move across the road and go to another building, it doesn't affect their business at all. But you take this service station and move it around the corner, if you can, it declines the business. So they've got enormous amounts of goodwill. Sometimes, that's where the lion's share of the value in the business is in that goodwill, and it's location goodwill. It's not just business goodwill.
Yeah, it's got the flexibility. So we actually bought a service station in Western Australia, and I didn't even think about this. The electric charging station, they actually put a dog groomers at the end of it. So they get all the business from the dog because they come up, they turn up for their 20 minutes, their dog gets groomed, they go have their coffee at the restaurant, the petrol service station. So there's flexibility like that. I didn't even think of until I started looking at them.
Yeah, and we've got great value add opportunities. We can put car washes in, we can put fast food restaurants in there. Certainly, there's a lot of the car wash come with these dog wash areas. We've got some great plans to add value to these assets.
I imagine they typically don't have.
Sorry, if I can just add to that. Just add to that is that those calculated returns we've got of 8.5% and 12.25% don't account at all for the value adds that we've got in mind. That's a bonus that sits on top. Our view is if you can't count on it, don't promise it.
Yeah, well, what I was also going to suggest is due to these more regional areas, there's probably not a limit for height as well. So as we move on down the track, they can build second levels on the retail section, and that can be where the lifestyle is, and they can always adapt that way.
Yeah, there is that opportunity, but I think that the sites we've got, most of the big ones that are in the bush, they've got vast land, and construction costs where they're going at the moment, building up doesn't make too much sense when you've got the ability to build out.
I'm referring to kind of 10, 20, 30 years down the track.
Yep. Yeah. Oh no, that opportunity there, because they are commercially zoned sites. They do have the capacity to include other uses, and heaven forbid, if there was a service station to sit there and you had to go up a set of stairs to get to McDonald's or Hungry Jack's or Guzman and Gomans, it's totally in the realms of possibility that you can do that, rather than if you had a land shortage.
James says, I own gyms, and you touched on the possibility that these sites might include gymnasiums as well. He's wondering if that's a possibility.
Look, anything's possible. We if there was a gym that wanted to go there, and they could sort of see the value in it. But the thing we can get to do is we can provide space without land content in it. So look, it's a possibility. I haven't seen one yet, and even through some of the large stations that are in Europe and America, I haven't seen one yet. But look, anything's possible. But I certainly think for some of the big truck stops, a small workout area for the drivers would be welcome. What we've noticed since we've started these investigations is that the truckie of old no longer exists. They are quite sophisticated. They're very aware. They're sitting in the restrooms on their laptops. A lot of them are small business people that might own one or two vehicles, and they're doing their business in those offices. So in those truck stops. So it's the fair dinkum old Aussie truckie, I think, is a little bit of a dying race, and we're seeing more sophisticated facilities required for them. Business centres, really clean showers and toilets, resting stations, because of the legislation that forces them to rest up.
And also the reality.
Point, Peter, like 15, 20 years ago, truckies didn't even have an iPhone or a smartphone. So now there's laptops and computers. There's a completely different demographic of truckies now.
Yeah, it's a bit of a frightening prospect when you've got a B double bearing down and you think that he might be watching something on his telephone, though.
If he can get a Wi-Fi reception.
Just as a bit of a side topic, one of our clients is the person who installs safety equipment on trucks. So they retrofit all the cameras and automatic sensors and stuff. So it actually is, when their eyes are off the road, there's alarms going off left, right, and center. So they actually have to keep their eyes on the road now. And the main benefit the trucking companies are actually implementing these is actually their insurance premium goes to about 50% because they're safe. That's where the big cost for trucks is maintenance and insurance. So that's what business is probably moving forward as well.
Yeah, that's an interesting thing. That it makes a lot of sense.
Cameron's asking your views around the contamination risk. Peter, I know you did touch on that earlier, but perhaps you could reiterate that for Cameron's benefit.
Yeah, obviously, it weighed very heavily on our minds when we were looking at these things. And again, sort of referring back to the previous comment, it all goes back to the lease. So in the Chevron leases, they adopt the site if there is any contamination, they must remediate that on the site. So there is no risk whatsoever. Chevron themselves are responsible for the remediation of these sites. And the leases go a little bit further than that. That they're saying is if there's adjoining sites that are contaminated as a result of what the activity on that site, they remediate that as well. So we went through and had an environmental scientist and have a look at all of the sites and have a look at all of the reporting that happens year on year. And again, go back to the lease. That reporting requirement is actually written into the lease. So they go back and they do four levels of testing every year. And that we've had these environmental scientists go through and have a look at all of those reports, and their recommendation to us, their risk analysis to us across 7 sites, they are all very, very low risk. Sorry, I won't embellish that. They are low risk to the landlord on every site that we've acquired.
Okay. Yeah, for Cameron, the main risk is when you don't have a tenant. So i.e. if you have a service station and the tenant leaves in 20 years time and then there is land contamination, you can still repercussions and try to chase that money back, but it's obviously there's a whole web sometimes, and I don't think it'd be these ones, and Peter, where they can obviously have corporations that dissolve and liquidate and things like that. But it's when you've got a lease, you've got that security.
That's right. And under the leases, these people, they need to, with Chevron, they need to remediate before they leave. So they need to remediate in the lease tail that's at the end. So and if they do vacate, they're not released from their remediation liability.
John is asking what's the term of the trust, and also he asks what is the exit plan at the end of the term.
Yeah, that's a really good question. We focus a lot on that. So it's a 4 + 4 year term. So we'll run it for 4 years and then make a decision whether we continue on or not. And if we do, we'll go for another 4 years. The exit strategy is really important, and that's a great question, John. We can either sell these as a portfolio, or we can sell them individually. And so that gives us some flexibility. We can sell them over a period of time rather than saying, oh, you can buy the lot, or today you can buy one of the 7. We can actually sort of ease out of the portfolio across a period. If we come to a time and somebody comes halfway through the trust and offers us a ridiculous sum, equally we can take the option to exit at that stage of the game. You know, it's that's part of our role as the fund manager, is ensuring that at all times every decision we make is in the best interest of the unit holders.
Okay. Peter, it might be a good time if you could perhaps share your screen again and just leave us with that last slide, because we're getting towards the end of the hour and time to wrap up the discussion. But want to let people know what they can do and how they can make contact if they want to find out more and would like to follow up with you. So you can see the contact details for Peter Rossi, Chief Investment Officer for Amplify Funds Management, the phone number and the email address, peter.rossi@amplifyfm.com. So just leave that there so that people can make a note of it if they're interested in following up. Just some final thoughts from you, Steve, before we go back to Peter. What are your thoughts on what we've talked about today?
Surprisingly, I really like it, and me and Terry have had this discussion a few times about how I'm very weary about metropolitan service stations. But the more we got into this conversation, I'm on side with Peter 100%. Like the more regional ones are a very secure investment, at least for the next 30 years. So like we're not changing. So with the return on investment at 8.25 or 8.5%, Peter?
8.5% cash on cash, yeah.
Yeah, just that alone without capital growth is a good return for any share fund.
Yeah. Okay. Well, thank you for that, Steve, and thank you in particular for getting up at 4 o'clock in the morning. I really enjoyed this discussion. I'm glad you've been able to be part of it. You made a great contribution. Your knowledge of all things commercial property, as always, is impressive. We're just conducting our feedback poll as I'm speaking while we're watching the result of that come through. Peter, if you could just give us your final thoughts before we wrap up the discussion.
Yeah, from our point of view, it's really interesting, and I've actually got a couple of questions for Steve. You know, we've never met, and just in terms of the investors that you're seeing and your client base, the appeal of being able to get into what is effectively a large investment that you need you need a large sum of money for, being able to get in at sort of the $100,000 as a minimum investment. Do you think that there's a sort of a component of your client base that'd be interested in that sort of thing?
Yeah, well, I'm going to share this on all my networks, Peter, so they'll definitely be. But like you said, with $100,000, you can't buy much in commercial now. Like even leveraging at 70%, you're talking what, a 300 grand asset? Like that's getting you a very small warehouse in probably a regional area or a Perth or something like that, or a little retail shop. And you're definitely not getting a 10-year lease. Like you are talking 1, 2, 3 year leases, so more volatility there. So these funds are, and I've actually been involved in one of these similar funds about 5, 6 years ago with my previous employer. It's a good way to basically diversify the risk, because you put in lots of assets, not just one. The negative is lack of control, but this is where you have good managers that look after the actual property for you.
Yeah. Oh, thanks for that. Yeah, no, look, this has been great for us. It's I've learned a lot coming through this. We're really keen to get going. Our capital raise, we've sort of started. We start tomorrow. So we've got sort of 5 weeks to do our capital raise, and then the fund will launch in September. So we'll go through. We'll get people's commitments from an expression of interest through an application. The day that they have to cut the check is in the first week of September. And then the fund goes from there, and that's that the clock starts ticking then. And from the day that we launch the trust, you get your return paid to you on a quarterly basis, and that gets deposited directly into your account. The other thing is, as I've said, we're co-investing. So Peter Honeycomb, Andrew Dowling, and I are all putting our own hard-earned money into this, and that's an important thing. And the other thing is that we're focused on is being available to our investors. So we're available. Our phones are always on. Our emails are always on. And if anybody's got any concerns, they can certainly feel free to reach out to us at any time. It's a very personal, very personable sort of fund that we're running here. And as I said, we're sort of a bit reluctant to call ourselves fund managers as such, because we really are co-investors doing the heavy lifting for the investors.
Okay. And that's a good note for us to wrap up. Thank you, Peter Rossi, for participating today. I found it fascinating. So many interesting elements to this type of property. So many good things to consider. Great feedback in our feedback poll. 100% found it informative and interesting. And I'm not surprised. I certainly found it so myself. Anybody would like to find out more, please follow up and make contact with Peter. The contact details are on the screen. And thank you one more time to Steve Polisi for participating from Polisi Property. And let's do it again soon.
Okay. Thank you and goodbye.
Okay. Signing off for now. Terry Ryder from Hotspotting. Bye for now.